Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Friday, October 11th, 2024. Today's episode, we will go over PPI and JP Morgan earnings first. As you saw yesterday, the CPI, on the consumer side of things, it surprised us to the upside for inflation. But PPI did the absolute opposite. All of these numbers are cooler than expected in last readings of this. Also, consumer sentiment, this is a survey done by the University of Michigan, a favorite leading indicator of many economists, also coming in cooling off for October. The Fed funds futures adjusted slightly more towards still one cut in November, and so it just seems more and more likely that what Powell has been saying, 2 cuts for the end of, through the end of the year, is looking more and more likely. I've been bringing up looking forward to JP Morgan earnings because it's important to see what the commercial banks see. It's important to see how they're doing, how they're with their business. They create a lot of money through credit, so it can help people really get a good some sense as to what's going on in that area. JP Morgan Chase shares pop 5% after topping estimates on better than expected interest income. They also I guess they had lower earnings because they're holding more money in reserves because they're expanding credit card debt. And it's like they said, it's don't worry, guys. It's not because we're worried that people are going to start defaulting on their debt. We're actually just, people are just taking on more debt. This is all while, by the way, that strong jobs report that came out, apparently, if you looked a little deeper into the numbers, a lot of it was part-time work, which is not good. You want the good growth is like more full-time jobs, less part-time jobs, really. And so there may, that the headline numbers, I think, are slightly misleading if you just take it on that. But whatever. The main point here with the JP Morgan stuff is that they came out and said everything's fine. And so the market took that as, okay, I guess we can continue being bullish here. That leads perfectly into the daily reminders. There's a lot of things indicating that we're headed straight into a very weak period. A lot of weakness in the economy, but I don't read through the daily reminders on Fridays. I do it on Mondays. Check Monday's show if you want to hear me read through them. The crystal ball reading remains bear market very soon, if not imminently, and that the Fed will not cut fast enough to save the economy. I've been noting on the past several days of shows that the S&P 500 has been looking like it's been getting bullish. There's some trend lines that were really cracking through here, and it's going up. It looks like it wants to get to probably the 6,000 level, but I'm not playing around with this. I don't touch stocks when they're this overvalued. I mean, again, look into the Schiller PE, the CAPE ratio. Dig into it a little bit. You will be just as scared as I am. I strongly believe that this is the correct time to be more fearful of the stock market than maybe any other time since 1929, right before the Great Depression. But I'm just the guy with a crystal ball. So I recently brought up the 10-year, 2-year Treasury spread. Now it looks like we might be headed back to inversion. We're bouncing back up. So that gives me a little bit of a sigh of relief, because inverting again to me just means that whatever recession or depression we're going into will be even worse. The longer that we push this out, I think the worse that it will be. Another chart that caught my eye today, again, I brought this up recently. It's the 10-year break-even inflation rate between Treasury inflation protected securities, TIPS. They're known as TIPS, versus the yields on 10-year notes. And this has been climbing. It's been going up and up and up. So it's interesting. We're pricing higher inflation right now. I'm taking this with a huge grain of salt, considering valuations where we are in the cycle. All the daily reminder stuff, that list of things, tells me that I probably shouldn't be reading into this 10-year break-even rate too deeply when it's going up like this. To me, it seems more optimistic about inflation than it should be. Again, I'm in the camp that we're headed into disinflation, deflation. But for now, the market's pricing a little higher inflation. And again, it's not like a lot higher. It's 2.3% average over the next 10 years. And that's how it's currently priced. The same metric was priced back in September at 2.03%. I've been talking also on the show for weeks now about how unbelievably tight credit spreads have been. I came across an article actually earlier today. I think it was from Bloomberg, talking about how there's been record amounts of money pouring into junk bonds right now. And it just made me laugh out loud, because okay, finally, someone's explaining to me what's going on here. Yeah, the market's getting real dumb right now. The reason you have credit spreads between different tranches of credit is because there's higher risk. Some of these bonds will go bankrupt. It's almost a mathematical certainty. But I wanted to bring up one other thing that caught my eye today. This is actually AA bonds. These aren't junk bonds. These are investment bonds. And even investment bonds have spreads that can get wider and tighter. And we recently, this is updated as of yesterday, October 10th. We actually cracked to new lows, 0.47% difference between AA bonds and treasuries. And I just want to scroll out to see the bigger view of this and point out again that this spread, the difference between what you can get on a treasury bond and a AA bond, we don't often go below 0.5%. In fact, looking at this chart, you can see most of the time we're averaging maybe 0.75%, and we sometimes go up as high as 1.3 in the dot-com. Before the dot-com bust, we went up to almost 5% in the Great Financial Crisis. In 2011, up to 2%, and then again in COVID, by this chart, 1.8% difference. It's funny, I get emails from Fidelity with tips on these different things, and people are getting pushed into bonds right now. My concern is that they're getting pushed into the wrong kinds of bonds, especially when credit spreads are this tight. You're not getting a larger reward for the amount of risk, additional risk that you're taking versus treasuries when credit spreads are this tight. I mean, I understand the allure of having a higher yield, but that comes with additional risk. And not only that, bonds will always go through periods of tightness and tight credit spreads and looser credit spreads, where they go, this goes up, where the yield difference between treasuries and higher credit securities has greater difference between the two. There will always be opportunities to buy bonds at a discount, but right now is not one of them. While everybody's pouring into corporate bonds right now, I'm pulling my hair out, screaming, Mr. Market, this isn't the right time to do that, man. It's not the right time. The right time to do that is when it's elevated. We often get to a 1% spread between the two. Look at this, 2022, almost 1%. 2016, over 1%. 2013, over 1%. And then before 2012, they were over 1% all the way back to 2007. So 7, 8, 9, 10, 11, 12. For 5 years, they were above a 1% spread. Again, 1998, we went from a very low, we got all the way down to 0.4, 0.38 at one point, and then popped up to 1%. That's the time to buy corporate bonds or junk bonds or whatever bonds, when credit spreads are wider, not when they're tight like this. Again, in 2000, 1.3%. That's the time to buy riskier bonds, when they're cheaper, not when they're more expensive, when the credit spreads are tighter. It's a bad Mr. Market. Bad Mr. Market. You're not being smart right now. While retail investors are less fearful than they've been in a long time, the VIX is still above 20. This is holding the 20 line. A lot of the time the VIX, what it does is it pops up and it goes right back down once things calm down. This is actually, look at the chart. This is setting up. This looks like it's setting up for another pop. This is a bull flag right here, and it's tightening. This is a wedge. So this chart is screaming that more volatility is coming. That we're headed into a risk off mode. One of the curious things is, how long will these divergences last? How long can they last before things revert to normal? It's the way that I'm kind of imagining it is, it's like we're taking two magnets that have the poles lined up so they push away from each other, and we're just trying to squeeze them together and squeeze them together and squeeze them together, or closer and closer and closer to not just regular magnets, those two giant neodymium ones or whatever you call them, and it's just like you have them in this like machine that's just pushing them and pushing them, pushing them tighter and tighter. Eventually they're going to go away from each other. Will this one go that way, or will this one go that way? Not completely sure. I'm thinking the big correction may be starting sooner than I thought yesterday, anyway. Longer dated Treasury yields seem like they might be at a little bit of a peak here. This is the 10-year Treasury note, looking like it's curling over here. Maybe this really is a top. Importantly, this is the 30-year bond yield Treasury. The 30-year Treasury bond yield. I said yesterday how I was surprised it chopped through this trend line that I drew from that goes way back out. I can scroll back out again to show. That goes to the top all the way back in 2021, and then has been holding this line here for forever, with this giant, massive head and shoulders top breaking recently and basically retesting. My whole thing on this is, are we going to have a close above the wick of this candle here or not? We did not have one today. So this still, even though it looks like we're adding yield here, that the yields are going up, that this little chart pattern here, as much as I know about charts, says that this can actually be a blow off top and we can head lower. Not that it necessarily will happen that way, but it's still in the cards. It's not impossible at this point. Yesterday I brought up Bitcoin, noting, well, it was a red candle when I did my show anyway, and it turned into a wick. You can see the bottom of this wick here was below this previous little dip, showing that it may be, it might be showing a lot of weakness. On a closing basis, we closed above this magical 60,000 level, and the bulls really took over here. I'm not betting anything either way on this market, but if I had to guess, it would make sense for it to go back down and much lower. I don't think right now is a good risk on time right now. Last chart of the day, IWM. This is the Russell 2000 ETF. I have been talking about for several days how I've noted there's been this tight consolidation here, and that it looks like a bull flag wanting to break to the upside. I said it just looks like it wants to break the upside, and it did. So the pattern played out. How much legs does this big green candle have? I don't know, but I didn't want to just bring up this part of the chart. Scrolling out to have the beginning of the chart at 2021, these are weekly candles. I've noticed recently that we have been in this sideways chop for, what is this, almost 4 years? It's been going for almost 4 years at this point, basically sideways. This is crazy. Like normally, a market like this is just like just going up and up and up, just casually. Or in a bear market, it's going down. This has been going sideways, which tells me that there's a breakout coming soon, and it's going to be a big one. It's going to be a doozy. Just the chart pattern alone, could it be an explosive move to the upside or an explosive move to the downside? I'm guessing to the downside based on the valuations of US stocks right now. There's a few other details I want to bring up about this chart. I have it now the way you see it, the way I have it. Let's make it a little bigger here. This goes back to 2001. I bring this up because I just want to paint a little picture as to what can potentially happen specifically in the valuation of these securities. I want to start by bringing up the .com bust, which brought the Russell 2000 down to around here. And we had a nice growth period all the way to about 2007. So for 4 years or so. And then we go sideways, sideways, sideways. We have the sideways thing, sideways, sideways, and then boom. And where did we go? If you look at the thin line, I don't know if you can see it, but we went all the way back down to the lows of 2002. And so I just wanted to bring up that, it's possible to lose 4 years of growth pretty easily, it seems, in this market. That's not the only time we saw that. We had this growthy period going up and up and up through 2015, and a little bit of a bear market in 2016. And then from 2016 to 2020, we went up and up and up. Had a little break in 2019 when they started cutting rates and saving the market again. Sideways, 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 sideways. Break down. And where's this bottom? It's about the same level as the bottom of 2016. Again, that's, 4 years of losing market value. So where are we now? We've been going, we had this monster run, sideways, 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 sideways. If we break down, well, would it be out of the cards for us to go as low as the bottom of the .com bust, or even lower? Some people note the high of 2011 and 2007 makes sort of a trend line that may, form some support here. But that would be more than a 50% drop in the value of this fund. And I don't think that that's out of the cards. especially considering how long we've been basically chopping sideways. If you know anything about charts, the longer the chop, the sideways goes, the bigger the breakout. So hold on to your hats, folks. We may be headed into a storm. Could even be the storm of a century. And that's all. From me and my crystal ball, hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.